Welcome back. Stocks are higher today, but still down sharply over the past week. As you know, our next guest sees now as the time to buy two of the sectors that were hit hard during the past few days. Joining me now at Post 9 Treasury Partners, Richard Saperstein, one of the highest rated financial advisors in this country, according to Barron's. In the top 100, you, my friend, were ranked number 4. Congratulations.
Thank you.
Which means your advice, as I always tell you, better be good. What are these two areas? What are the two sectors?
Well, look, Trump's policies have been very widely telegraphed, and now the market's trying to digest whether tariffs are going to be inflationary, recessionary, stagflation, whether DOGE will cause a slowdown, and whether immigration is going to have an effect on labor costs. So I think it's important to look through what's going on now in this current bout of volatility to the structural changes that are occurring as a result of this administration. That includes deregulation, flat to lower oil prices. We have declining inflation. We have an accommodative Fed, and we have an SEC that'll be more accommodative for M&A. So when we look at that, I do believe so.
Well, I mean, what's happened so far, you know, they've already said they're going to stick to the Biden era M&A rules. That was kind of a surprise to people, right?
Rules are going to change. I mean, everything's changing daily. Remember, years ago, we spoke about the risk of 500 basis point increase in the Fed funds rate, and that was the big risk. Today, the big risk is policies out of Washington, and that's what we have to pay attention to. But in the end, the landscape for investing will be more beneficial for corporate profits to grow.
Is the Fed still really accommodative?
Potentially, yes.
I mean, you would think, you come into the year thinking, yeah, they are less than we thought before, still accommodative. Now, I don't know. They're like sitting on their hands because they don't know the impact of tariffs any more than you, me, or anybody else.
Agreed. And I don't think we need the Fed for stocks to go higher. I think we've got to get through this period where a lot of these policies are implemented, creating the volatility, and look through to the sectors that will still do well.
We teased it here at the beginning, or at least we read it in the intro. You got two sectors that have been beaten down that you like. What's one of them?
Okay, so let's talk about utilities. The demand for power is growing 2.5% a year. It's not just from data centers, which is 40% of that demand. It's from residential, electrification, onshoring. There's a lot of power demand that's going to occur, and the sectors that we're looking at right now is the utility sector, specifically independent power producers. And there's two, VST, Vistra, and NRG. Okay.
Well, Vista's been crushed in the momentum unwind.
Absolutely, and it's a great opportunity to add. Right now, it's a $42 billion company, roughly $5.5 billion of operating cash flow. The free cash flow yield is over 7.5% on that company, so they're going to return it to shareholders. And it's in a position now where we're going to add to our position.
You are going to add to it?
Absolutely.
When are you going to do that?
As soon as I feel comfortable.
As soon as you get off the show? No, I'm serious. When are you going to do it? I wonder if you missed your chance. I mean, these things got crushed so bad. Some of them have rebounded a little bit.
We own it in the 20s since 2021, okay? So we're going to own this stock for 5-10 years. So I still think the market's going to be very volatile, especially through April 2nd when Trump's going to announce the product tariffs. These were just kind of fentanyl and immigration-related tariffs. So I think we have to be patient here. And look, I've seen these drawdowns for 40 years, and we don't have to just jump right at the first opportunity.
I guess the only thing I would ask about Vistra again is the idea that maybe after DeepSeek, we are coming to grips with the fact that maybe we're going to need less, not more, of everything. I mean, we're still going to need more compute, we think, but maybe it costs less. We're still going to need a lot of power, but if you can do more with less, maybe you don't need as much power as you thought initially. That sent these stocks literally straight up to the moon.
If you listen to Nadella's last interview, all right.
I know what you're going to say.
All right. So AI agents are only increasing. So we're going to need more compute, more data centers. We're going to need more power to fund all this, to power all those data centers. So I think it only increases the demand for for inference and compute.
Okay. And the other sector you would buy that's been weak is big tech.
Yeah, large cap tech. So Meta, 3 billion daily users. Google, 4 billion daily users. Microsoft, 2 million installed corporate base. Apple, 2 billion daily users, right? I mean, these companies have large moats, recurring revenues, and their operating cash flows right now. You take Amazon and Google, it's back up to 7.5%, 8% right now. So I think it's important for every investor to have these in their portfolios and not look at it as just a trade. These are long-term investments.
Sure, but I mean, you think Apple's worth 31 times forward?
Well, is the market worth 22 times forward?
Well, I mean, you need to answer that question. But I mean, Apple, are the fundamentals currently of Apple worth the premium of that multiple?
This is the biggest debate right now, and we can dissect it, services, products, but I own the company. I believe it's going to continue to grow. It's probably at a rich multiple right now, but I think it's got to be essential in everyone's portfolio.
We'll leave it there. Good seeing you again.
Likewise.
Richard Saperstein joining us back here at Post 9.